And in the meantime, let me give a disclaimer upfront. Like this spaces is purely educational. So whatever Himanshu will be sharing with you all is purely educational. And if by any means any names that would be so as to illustrate the framework or the in the what we say thought process which our guest follows, that is purely or for that only, that should not be construed by anyone for any sort of buy sell recommendation.
And also, I was following your page, Twitter handle, and you have done some wonderful service to the retail. So, totally free of cost. So, it's highly beneficial if you go through many spaces on his profile page. There are many I was checking today related to fundamental analysis, technical analysis. So, multiple aspects covered in there.
Thank you so much, Himanshu. Yeah, I mean, our guests have been kind to me, and trust me, like that some 85 podcast uploaded over YouTube channel are pure gem, and that has been like more than 60, 70 industry stalwart had shared their learnings and experience. So people can benefit even sector specific also, they can look for and fundamental technicals and everything. So let's, in the want of time, Himanshu, we are starting. So guys, let me take a moment to introduce our guest for today, although he's a very popular name and doesn't need any introduction. But again, he's a full-time trader, right? So he was into government service during the period 2016 to 19, but later he resigned. He found his interest in market, and like his entry to the market was through indirect mutual fund. But again, he had an inclination towards technicals, so he totally stuck to that, and he completed his CMT exam and waiting for his charter, and he has also got CFTe. So this is with this I welcome you, Himanshu, and any opening remarks from your end?
Thank you very much for hosting me here, and I'm delighted to connect with you. As I said before, that people should follow your handle for so many podcasts that you have already covered. Like you said, 85. So they are pure gem. They are full of knowledge, totally free of cost. So you can learn from. I think there must be around maybe 30, 50 hours of content. So looking forward to you.
That's great, great. So Imanshu, although like you had some previous great interactions with Ishmohit and one with Kumar Saurabh, so you people are already aware, but again there are always new attendees. So would appreciate if you tell us like how it all started for you, how you developed the interest, and how had been your, I mean, starting point with the technicals, and how you graduated learning those technicals. Yeah.
So I joined my government service in 2016. So uh, as per Section 80C, we have to save 1.5 lakh rupees under any investment scheme. Someone recommended me ULIP. I got stuck there. Then my friend called me and he explained me about mutual funds. So I was quite interested looking at the past historical return that everyone does that 20%, 15%. So I was fascinated. I was doing it, but I was not aware of the stock market, anything. I was not aware of anything. So uh, when I dwelled deeper into mutual fund industry, 2 3 months I studied intensively what is happening, what are these fund managers doing. Then I got to know they're buying some stocks. Then the movement of that NAV of even mutual fund was fascinating. So I tried myself to pick up some stock, because whenever I studied any mutual fund, they were having all those common stock, HDFC Bank, Reliance, and I studied the concept of market capitalization. Then I thought that these are all elephant giant size stocks, so they will take a lot of time to move. So I should look for some small caps, micro cap names which are hitherto undiscovered. So I then jumped into the micro cap investing. I studied many micro caps, and one of them, like, I was not aware of position sizing. I was making mistakes like other. I was also averaging down. So one of the micro cap, even though the data was pointing something else. I mean, the data initially was very rosy. The management painted a rosy picture. Even the CEO was awarded by state government. So I was constantly averaging down the stock. I don't know where to exit. I only knew about the entry, and then I lost. I mean, as per that capital size for me, it was a bigger position size that I lost in that stock completely. Management was caught with GST fraud. So I thought that fundamental approach is not always the 100% right approach. There is something more to it. Because then I started reading technicals from 2017, end of 2017 onwards. Then I started practicing on charts. I realized exit is equally important, because sometimes what happens, stock may drop down 30-50%, and fundamentals are only known in maybe, and I think with a lag of 3 to 6 months. So that's where you have to protect the gains that you have already made. So that's what prompted me to jump into the field of technicals. And then I devoted many nights. So that was also one of the reason of resignation. And that's how, I mean, it's I think around sixth year. So now I just check 95% technicals and 5% just basic funda after I screen a stock technically. So that's my approach. Mhm.
That's quite good. But I mean, being full time is one thing, but leaving a job is a tough decision in itself. That too, I mean, you started somewhere in the year 2016, 17, and taking such a big decision after true 2, 3 years, and that too a very reputed job. So, how difficult or how easy it was for you?
Uh, when I was in government service, I was teaching some 11, 12 class students for their entrance examination, and I was making a little bit money. My expenses were very low. So one confidence that gave me, what my lifestyle was very simple. I was living in a one room rented apartment there somewhere in Mansarovar Garden in Delhi. So rent was very low. So my expenses were very low. So even if I knew that if I will resign, my expenses are seriously low. So I was just trading one horizontal line. I traded with confidence in 18-19 market. Now also I am doing the same thing, back to the basic, just drawing one horizontal line, buying above it, buying below that. In a weaker market condition, I'm sitting out. In a stronger market condition, I get in. So it was a initially it was difficult decision to think for that. I prepared myself for 6 to 7 months before taking that decision, and finally thought of resigning because I was not able to do justice even to my job. Uh, Also considered multiple other factors, so that prompted me to resign from the service then finally.
Great, great, great.
Mhm.
So Imanshu, like, if I were to ask, like, how you start, say it from idea generation, or you run some screeners, identify trends, or whichever way you start. I mean, how you start, and then you further look for the technicals, and how you decide amongst those good setups which you came across, and any company. So how you go about it?
So, relative strength is the cornerstone of my investment strategy. I look for relatively stronger stocks. So, if you read a book, How I Made $2 Million in the Stock Market by Sir Nicholas Darvas, every beginner should read this book. And he's mentioning that I was constantly looking for the stocks that are floating near the highs, or they are resisting the decline. So when the market corrects, when the market is going down, you will see some stocks that are not going down with the market, or they are floating near their highs, and then they start their journey. So relative strength fetches out somewhat around 200 to 300 names in this market condition it will throw up. So what happens when market starts bottoming process, or even before, when it starts moving up, these stronger stocks make their move very clear. I mean, they cross their highs, they make a move. Even in this market for the past year, you see some stocks like Mirza International, otherwise Elecon Engineering, BLS International, they moved 100% plus in 3, 4, 6 months. Mirza moved from 70 to I think around 380, 400. So relative strength is the core principle. Now there are multiple ways to gauge it. There is one ratio analysis, but that's a cumbersome process, taking ratio of TCS with respect to Nifty IT, or maybe Infosys with respect to Nifty IT. So you need a good scanning software. I use MarketSmith India. So the relative strength you can get on various multiple softwares. That throws out some name, and then I'm looking for the stocks that are above the key moving averages, that is 50 MA or maybe the 200 MA. And other things are like some IPO stocks, those listed within 2 to 3 years. I'm checking all of them because many of them do not have enough trading history. So they may miss your relative strength scan. And one scan I run is the top performers, I mean the top gainers of the past 1 month or 2 month or 3 month, and gappers, like the stocks that gap up. Now gap up may be because of multiple reasons. It may be because of earning announcement, or maybe new CEO, new management, new product, new service being launched by a company. So gap stocks, like breakaway gaps, the stocks that crosses the resistance with a gap, they are known by many fancy names in the market now. Earnings gap, episodic gap, this gap, that gap. Basic concept is very simple. A stock, because of some announcement, gaps up and crosses the resistance with a noticeable gap. So these are my technical setups through which I scan some stocks. When the stocks get filtered out, immediately you can get to know, okay, now bunch of maybe banking stocks are passing the screen. In February, hotel stocks were passing the screen. Then after 1 month, I think in March or April, all paper stocks were passing the screen. So these stocks will take you to the leading sectors, and then you may either have a basket approach where you buy top 3 4 stocks from a particular sector, or you have a concentrated approach where you buy just one name or two name with bigger position size. Then I check the basic funda, because if 10 stocks qualify, let's say 3 or 4 are from a leading sector, so I will give preference to them instead of 3 or 4. For instance, if you ask me, post COVID, IT and pharma was the leading sector. So any stock breaking out, you see on 23rd April, Loris Lab, then pharma, chemicals, and IT. So alkylamines, these were all very, very strong charts coming up. So leading stocks from leading sectors and relative strength.
So Himanshu, like often people have a confusion, like they misconstrue relative strength and relative state in sorry, RSI and RS as one thing. So would appreciate like if you differentiate on this, and does RSI play any role in your investing framework?
See, whenever a transaction is done between a buyer and a seller, price, volume, and time is printed on the chart. Only three things are printed on the chart. Even when you go to any supermarket store, you get a receipt. What did you buy? How much did you buy, and what time? Price, volume, and time. These are the three primary sources of information. Now, anything RSI, MACD, stochastic, William percentage, or alligator, any indicator is derived from either price or volume. So RSI is derived from price past 14 days. It is a concept, Sir Wells Wilder's concept. He has written a complete book in 1978 on RSI. Our relative strength index is an indicator. Now, relative strength index is telling me my performance compared to my own performance of the past 14 days. For example, you take RSI of, let's say, Infosys. So RSI of Infosys is telling me how strong is Infosys compared to Infosys itself for the past 14 days. Then RSI has is an indicator which moves between 0 to 100. People generally call it, when it crosses 70, they call it overbought. When it crosses 30, they call it oversold. 30 to the downside, they call it oversold. And there are multiple other applications of RSI with catching the tops and bottoms, or divergence is multiple application. Now relative strength is telling me the performance of Infosys compared to all IT stocks. So relative strength is like you are making a cricket team. Now you are picking the strong players in your team. So if you see, like Virat Kohli, he's a relatively stronger player. So how do you know? RS is telling you how well he performs compared to other batsmen. So you see the ICC ODI ranking, that is your relative strength. You rate the players in sequence in descending order. That's relative strength. So RSI is an indicator. Yeah, people confuse a lot between RSI and RS. So RSI, I use it only when the market is near the top or near the bottom, to check if there is any divergence. Now, again, you should not have this misconcept that whenever there is a divergence between price and RSI, price will correct. No, that's not true. Before COVID, price was moving up, but RSI was forming constantly lower highs. Yes, that was a divergence which resulted in price correction. But if you check the chart of Nifty for 3 months, after this COVID, from 15,300 to 15,700 or 800 zone, when Nifty spent 3 months in that range, price was flat, RSI was forming constantly lower highs. So if you think that price was always correct, no, price broke out strongly and RSI also broke out. So they both have to come in synchronization, one direction. If there is a divergence, then that divergence has to be sorted, and price correction is not the only way to sort that divergence. RSI can also come in the direction of the price. So RSI I use only for spotting the market tops and bottoms, or if let's say you love a stock, Divi's Lab, you're a fundamental investor, you want to catch the bottom in the stock, that time you can just open any indicator, be it RSI, be it MACD, be it William percent R or stochastic, any indicator you pick, they will show some sort of divergence near the bottom. That is one tool. Like you're a car mechanic, you have plethora of tools with you. You can just use one tool, maybe any indicator, RSI or MACD. Yes.
So Himanshu, you talked about three elements: price, volume, and time. Would you mind explaining each one of the significance of each one? How you, I mean, when it comes to price, what all we need to read, what be it in sync with the trend going on, and when it comes to volumes, how one can, I mean, especially the beginners can read it, what volume is indicating, and time in sync with the moving averages which you use. So that would be really helpful for our attendees.
So, price is the transaction price between buyer and seller now. Now, that's the primary source of. Let's say you sold a share to me. I am the buyer, you are the seller. We bought this share at 120. We did this transaction at 120. 120 gets printed on the chart. Now, some people fight constantly that fundamental work or technical works. I say, suppose you are a big fund house or maybe a mutual fund house or maybe a very learned individual investor. You researched about the company fundamentally, you think the company is undervalued, everyone else around you is now considering that company to be undervalued. What will they do? They will buy. uh, what it generates demand now for this stock, because they may have multiple reasons for it. As a result of that demand, they are willing to pay price. So let's say the stock is quoted at 120. Next investor comes, he thinks that till 140 or 130 the company is undervalued, I don't care, I want to buy. So what happened? As a result of this huge demand, price moves up. It's a very simple scenario, like when you buy vegetable in the market, if there is less supply or maybe more demand, the price will move up. So similarly in the stock market, people come in here for multiple reasons, they move up the price. Now price moves up, and simultaneously you have to note down the volume at the bottom. You pick up the chart of any performer that has moved 300, 400, 500% within 1 year or 2 year, pick up their charts, you will see price moving up with volume. Volume will be very high, number of transactions should be very high, because usually, I am saying usually, retailers do not act in a group. So what happens? You have to whenever you read a chart, just for the beginners, just open the weekly chart and then read the price and volume together. So whenever the volume is very high, the candle or bar chart, whatever you use, the price should close near the higher end of the range, and price should be moving up. The candle body should be very wide. So price and volume, this you have to read together. Now what happens? All these stocks that made the top, Indian Energy Exchange, DMart, CDSL, IRCTC, GMM Fodeler, so many examples, you open their chart, whenever volume is very high near the top and the price moved up but closed near the low, that is the sign of distribution. There you have to be very very alert that someone is now selling this stock, or someone has trapped the retailers in, because if volume is very high, transaction took place, there were buyers and there were sellers. So if buyers were so strong, price had to close near the highs, not near the lows. So who sold the shares? That means the selling power was very high. That's what Sir Richard Demel Wyckoff writes in his book, Method of Trading and Investing in Stocks, about buying wave and selling waves. So that price and volume should be read in conjunction, together. If you just focus on one idea, price or volume, you will miss the complete story. All these stocks, whenever they show topping signals, they will have price closing near the lows and volume will be very high on those days. So even though price closes, let's say 1 rupee above the open, now your volume bar will be green color. So you will be deceived. You will be thinking that, oh, this is accumulation. Someone entered the stock. No. If someone entered the stock, price has to close near the highs. So that's how you read both of them together. Now, just one example, I'm giving you carousel chart. Open the carousel chart now. Price is moving up with strong volume. So news, maybe there may be some upcoming news which I'm unaware of. I'm not saying you to buy, but that will be a good sign for you to learn how price moves up with volume.
Right. So Himanshu, there could be occasions when I mean the distribution is happening, but the volumes are not compared to, I mean, not high. They would be like reasonable or low. Is that possible, or that won't happen in distribution?
Usually in those cases, then your base that, see, many smart hands, or you say many fund house who have to get out, they are holding bulk quantity. They are not holding 100 500 shares, so they have to distribute slowly. They cannot do it in one day, otherwise the price will fall vertically. So they have to spend some days in there. Now if the news impact, I mean, this is as per my experience, if the upcoming news is very near, they have to do it in a rush, then it will be maybe 2 weeks or maybe 3 weeks, or it may be a climax move. Like, what is climax move? You saw in the chart of CDSL from 900 to 1500, IRCTC that time from 3000 to 6000. CDSL, Indian Energy Exchange, sorry, it hit a 20% upper circuit when the bonus news was announced, and then the price closed near the lows, the complete top made. So these are the climax top when it is done in a hurry. When it is done slowly, that time the base will be so frustrating and so long, maybe 4 months, 5 months, 6 months, it keeps on going, that you will wish that you push me out in a day or a week. I hope you're getting my point. I don't want these long bases on the top, very long bases. At that time, yes, distribution may happen, and that time you have to have your stop loss. But in that case, by that time, your longer term moving average will be broken. So if you check the chart of Aarti Drugs, the stock did nothing after the 400% move. It was in a range for almost 1 year, and then it broke down. But in that 1 year range, your moving average will catch up and the stock will be closing below that. If you pick 200 days moving average, it will close below that. So in those cases, your moving average will save you. Mhm.
Right. So you talked about moving averages. So can you tell us about like significance if somebody is trading for a very shorter period or medium term or long term? How could they the moving averages, which moving averages they can refer to and would be helpful for their trades?
Yeah, this yeah, this question is very close to me because I answer almost 1,000 times this question. What happened in moving average is the average of past certain periods of closing price. 200 days moving average means past 200 days closing price moving average. Why is it moving? Because on the 200 first day, you eliminate the first day, you take the latest 200 days. That's why it called as moving. Now, for moving average has many application. One application is trend identification, which means that 200 days moving average, anything above it and the 200 MA sloping up, you tell it it is in an uptrend. Below 200 MA, you generally call it to be in a downtrend, and 200 MA also sloping down. Like in the chart of Biocon, Bandhan Bank, you will see this concept. So for longer term investors, 200 days move, not investor, positional traders who want to capture the maximum portion of the trend, 200 days moving average is a fair number. For medium term investors, what I say that, see, there are only positional traders, swing trader or intraday. For swing traders, 10 or 20 period moving average is enough because they are anyway capturing a swing, they are selling into strength, nobody is waiting for the pullback. Or intraday trader, I don't do intraday trading, very seldom I do, so I don't recommend moving averages on the chart. That's just many strategies in intra trading, like VWAP strategy, Bollinger Band, so many strategies on intraday trading, because you are just trading for 10-15 minutes. So for longer term moving average, application number one, trend identification. Application number two, trend strength of the trend. Like any stock that is above 200 MA is obviously bullish, but it is, if it is also above 50 MA and 50 above 200 MA, we say it is in a strong trend. Above 20, 50, 200, 20 above 50, 50 above 200, we call it in a super strong uptrend. Like you see the example of Venus Pipes and Musdoc, when they made a move of 100 to 100%, they never even broke their 20 period moving average for a long period. So they are super strong. So second application is trend strength. First was trend identification. Third is your dynamic support and resistance. These moving averages act as dynamic support and resistance, and the price bounces back from these longer term moving averages because everybody uses that. And the fourth application is mean reversion. Anything cannot go up vertically or down vertically without they're too far away from moving averages. So in those cases, moving average, either the price will consolidate and moving average catches with the price, or the price corrects itself and touches the moving average. So these 4 5 application, others are just golden crossover, death crossover. 50 MA crosses 200 from below, we call it golden crossover. It's good for invest, but I don't use these application for entry and exit because often they are very late. Mhm.
So, if we talk about the various stages which we have, say 1 to 4, so there could be times like when the stock is in stage two and it takes some breather and forms a base. So, how one can identify whether it's distribution or it's cooling down for next league of rally within that?
See, usually in a strong stock, when it moves up, breaking out above that moving average, for example, Tata Power at 65 rupees, Bombay Stock Exchange, BSC chart at 680 pre-split, pre-bonus. When they move up, now after that 20, 30 or 40% move, they form the second base. Now during that base, you will be again having some volume markers in that base. Whenever the stock corrects itself, no, I shouldn't say correct. Whenever the stock retraces, or you can say pull back, the volume will be very less. Selling volume will not be high, and whenever it bounces back up, the volume will be high. So, in even if a stock is in a base formation stage, you will see volume markers. Whenever the price has a strong white body candle closing near the high, volume will be high, and whenever the stock corrects within the base, the volume will be very less. So different traders, legendary traders, named it different way. Like Sir Richard Emil Wyckoff called it buy wave, selling wave. Sir Nicholas Darvas uh, called it box theory. When the stock is floating in a box, when it breaks out, he will buy at that time. So he was constantly observing what is the retracement. So retracement will not be very high in stronger stocks. So distribution will be clearly visible by the price and volume marker. The opposite of it, price closing near the highs, volume high, these are like strong signs of accumulation. And anyway, you are buying when the stock breaks out, you always have a stop loss below the base formation. So if you are pyramiding up, you have to always buy when the stock breaks out. Always buy in the direction of the trend. That will help you.
So is it when the stock breaks out, or there could be one entry when the pullback comes and the stock retraces again. So whichever of these two is a better way to get into a stock.
uh, Basically, breakout trading now these days getting most misused because people usually draw a line at 52-week high or maybe a multi-decade high. They draw a line and then they say this is a breakout. No, that's not a breakout. What happens before that breakout zone? There will be a zone where the stock will calm itself, the supply will be absorbed, buying zone shifts upward, and then you see there will be a least risk zone where the stock decides it move. So that is the first buy point, which many traders, Sir Mark Minervini mentioned in his book, Sir Jill Morales mentioned in his book Buyable Pivot. So many traders have explained it. What you see at the obvious high is the second entry point. The third entry point, if the stock pulls back or not. Now what happens? there is a concept. Now, for if you have taken the entry before that obvious high where the stock decides its direction, that is the ideal breakout level where you have to time your entry, because that is the point when the stock decides what will it do. You are very close to the danger point also, or the stop loss point also, so your position size can also be bigger. Now the stock moves up, it crosses the obvious high point, that is the second buy point. Now at this second point, second buy points in a weak market, some traders get nervous because the stock will pull back, may pull back deeper, because the breakout point was much before that obvious high. So what happens now? Second entry, after that second entry, if it pulls back, and then when it is moving up, that is your third buy point. So for anyone who doesn't want to buy at the breakout, like I was discussing with someone, he said that I'm not comfortable buying at the breakout. Now that, sir, I learned so much from Sir David Ryan. He says that I usually sometimes I usually wait for the stock to break out and move up. So I want to know how strong the buyers are. I want confirmation. And when then it gives the second pullback buy, I buy, or when the second time it breaks out, I buy. So there is no one particular way of approaching a stock. You can buy at that least risk entry, or the buy point, the obvious high buy, and the third will be your pullback buy. Mhm.
So, Himanshu, like I see many people tweet about the candles, doji formation, hanging man, and whatnot. So, is this a important aspect to know about all the candles, or that significance is not that much? We can do good without that also.
Say because you have asked me, because I have read about candlestick, that's why I'm answering. If I wouldn't have read, I would be still trading the same way, because if you use bar chart, that's why sometimes I use bar chart, because individual candlestick will often deceive you. You will say, oh, bearish engulfing, then this index will fall. You see the journey of Nifty from 9,000 to 12,000, there were three instances in the middle when Nifty had bearish engulfing candlestick pattern. So candlestick pattern, first thing, very important to understand. You pick up any technical analysis book, candlestick pattern is under the chapter short term chart pattern, not long term chart pattern. So candlestick, you cannot say, oh, there was a hammer in this stock, so the stock moved 400%. No, that's not possible. So even if you do not know the candlestick, you just know the basic, that what wick signifies, what the body signifies. So candlesticks add one important tool to your trading toolbox when the stock is at critical levels. Critical level mean maybe it is at a support, so now you see, okay, hammer coming up, so maybe this stock can get support here. Or when it is crossing a resistance, a wide body candle, maybe a engulfing kind of candle, that time you can say, oh, this is a very strong breakout. So other than that, you can also trade without knowing the candlestick, so that's completely possible. You can open a bar chart also, and you can trade peacefully with it also. So candlestick, if you know, better. If you do not know, it's okay, still better. If you know, you can just add one more tool to your decision making process. Mhm.
So, Himanshu, is there any way to identify the strength of accumulation or distribution, or there is nothing such as strength in accumulation or distribution?
uh, so that's what I say, what happens, that strength of accumulation, if a stock consolidates for, let's say, 1 or 2 days or three. See, firstly, the base formation. Now you are focusing on the base formation. Before that base formation, how was the stock move? Was it vertically up? I mean, did the stock move up strongly vertically, like 15, 20, 30% within 2 weeks, 3 weeks? Now after that move, if the stock consolidates for maybe a week or maybe 2 weeks maximum, it may break out strongly again. You will see. Now this is a very choppy market. Otherwise, I would have shown you many charts like Finoplex cable. You open the chart today, or even ITC chart also was very strong till morning or afternoon today. So accumulation in these cases is very, very strong, because what happens here, the buyer is not willing to wait. They are accumulating the stock. Venus Pipe, Musdoc, so many examples in the past. And if the base is very, very long, now what happens before any upcoming news, Now, if accumulation is being done for 2-3 months and the stock goes in a very, very, very tight zone, maybe 6%, 4% deep, I can then place a bet there. So, strength of the accumulation is decided by how the supply zone, or you can say the buy point, is shifting upwards, the stock near the highs. That where you have a higher probability of strength. But number one setup for me is that the stock makes a move, strong move, and then it floats near shorter term moving averages, and then it breaks out. In those cases, the buyer is not willing to wait for even 1 month or 2 months. They are accumulating the stock very, very faster, very rapidly. So in those cases, the accumulation strength is very high. Other than those cases, 1 month, 2 month consolidation, if you see, uh, then in those cases you have to look for the supply zone shifting upward, the stock consolidating, these cases. So anyway, I mean, if you understand, if you take from the strength of the accumulation, it is decided by the, not by the base, but by what the stock did before the base. Because if I show you the chart of Tata Investment, open the chart of Tata Investment, you will see a long base, but the stock corrected from the top for 20%, 30%. In those cases, this is not accumulation. So you will be fooled if you buy those breakouts. Like DMart, you see after it corrected from the top, it had a long base. That's not accumulation. So strong accumulation, strong distribution is decided by what stock did before that base formation. Mhm.
Right, very good, Himanshu. So, Himanshu, like when we see for volumes, so when we say high volume, is there any set number, or if you see like say if 20,000 trades are happening on daily basis, you get a volume of 25, 27, 30,000. So, would you call that as a big, I mean, spike in volume, or it has to be some percentage, or how it goes when we study volume?
Uh, actually, see, if you open the chart of Carry Seal today, or just open the chart of Mirza International during the period of, I remember, June first week, second week, June to the period of October, just open the chart of Mirza International. When it broke out in the first week of November at around 70 level, just open the weekly chart. You will immediately see the volume very clearly. Volume, you will see the huge skyscrapers on the chart. There will be very, very tall towers, price moving up. So that's not retail entry. So one stock makes a move of 100, 200, 300%. I have usually seen that for many, many weeks, you will see these huge skyscrapers. So if you compare the volume by just visual analysis, you can identify. Other than that, I mean, these stronger stocks will have generally high, huge, tall skyscrapers on the chart. So high volume, if you ask me, uh, it's pretty much visible just by visual analysis. Some people use moving average on volume also, like in the volume setting on TradingView or any charting software. You can take the average of volume, average of past 20 days volume or 50 days volume. But with my experience, I'm saying you keep it very simple. Don't overcomplicate the things. You can just see those tall skyscrapers on the chart. Just go and check the chart of Mirza International. You will get my answer from June to, I think, if I'm not wrong, 1st November or 2nd November when it broke out at 63 level. Mhm.
And one more thing, like Himanshu, when the volume dries up, right? So what does it exactly signify? Does it signify like the free float which is available has been cornered, or is there any other significance which we can read through the? I mean, if volume is drying up.
So, volume dries up again, depends on where are you now analyzing the stock. The stock has now started to make a move, like Tata Power at 65 started to make a move now during 90 level, 95 level, 100 level. If the stock, after making a move of 20-30%, pulls back, retraces a little bit, and the volume is very low, volume dries up, now that's not a point of concern. But near the top, when the price is closing near the lows, volume is high, you get the first distribution signal. Now, after that, for 3, 4, 5 days, volume dries up, then that's a sort of trouble on the chart. Now, just to give you one example, just open the chart of Adani Enterprises. So, you see the Adani Enterprises, if I'm not wrong, in uh, fourth week of December, when the stock corrected from 4,000 level, After that, for 1 week or 2 week, it was floating on the right hand side and the volume dried up. Now you have to understand what happened before that volume dry up. Before that volume dry up, there was clear distribution sign on the chart. The stock had 3 down days near around 22nd or maybe 21st December, 3 down days, and then the volume dried up. So you have to really see that volume dried up after these distribution candles or after these accumulation candles, and where your stock is right now. Is it just starting the move, or it is sitting after 500 1000% move, sitting near the top where you have the distribution candle already on the chart? Then that volume dry up will be a good opportunity for you to either go long or short in the stock.
Right. So let's talk something about the trend line, and I mean that what we need to, how many touch points should be there, and what does that signify? So as to simplify how ideally one should plot, although it is dependent on individuals how they see things, but what should be an ideal way to go about it?
uh, See, trend line. Uh, Firstly, trend can be upward, downward, or sideways. Like if you ask me the trend of typewriter industry, I will say it is in a downtrend. So similarly, on the chart, you can see any stock. You can open the chart of any stock. Just open the weekly chart, and you will see. Okay, this stock is uptrending stock. It is moving up. Now, how do you know? By visual analysis. Sometimes you can draw a trend line also. Sometimes, not always, every chart will have a trend line. So, trend line is just one tool to identify the trend. The first primary tool is visual analysis, second is trend line. So, minimum 3 touch points are required. Otherwise, with any 2 touch point, you can draw a trend line. So, minimum 3 touch points, and it is just one way of identifying the trend. Don't, I always say to everyone, don't make things complicated. If you do not want to draw a trend line, don't draw it. Just focus on the trend and buy more stocks. When your any stock in your portfolio, it starts moving up, buy more of them, pyramid in them. So this way, have a trailing stop loss, pyramid your stocks. This way you don't have to worry about trend line, because when a stock comes to touch the trend line, that time, in most of the cases on the longer term chart, the stock has already corrected 20-30% from the top. Now, if you can identify a trend line, better. If you cannot, then also still better. You can make money without trend line also.
And Himanshu, like I have seen a peculiar thing, like we draw things which we want to see. So that is one thing also which creates. And so any other tools you would like to talk about? And in the meantime, like for attendees, if they have any questions, now you can send in a speaker request. I'll approve, and Himanshu will take your question.
So I just use price and volume chart, and when I was beginner, I was tracking CCI, RSI, MACD on my chart. And when you go to the temple, there is only one god, like price. So price and volume, only two gods in your temple. So if you apply too many indicators on your chart, and if you make your chart cluttered, it will be very difficult for you to take any decision, because two indicators will be suggesting a buy and third one will be a sell. So better to practice enough on pure price volume chart. And moving average, I won't say it to be indicator. It's just the average of price, just smoothens the price, reduces the noise, reduces the volatility. So this is all what I use: price, volume, and moving average on the chart, nothing else. Mhm.
All right. So, Himanshu, like when it comes to portfolio thing, so how you create your portfolio, and like if I were to ask, like say in case of positional or swing trading, so how the criteria goes for entry and exit, in the sense like how long have you? I mean, any past example which you would like to tell us, like in technicals, how long can we ride the trend basically, or is it like the strength can last for months only, or it can extend beyond that also?
So, firstly, how long can you ride the trend? The aim of a technical analyst is to identify the trend and ride it unless you get a trend reversal. So that stock will tell you till how long will it take you with it, because you cannot dictate, okay, I will hold on this stock for 5 year or 4 year. It may be possible, like you saw one stock, Sequent Scientific, it was moving up, people made money, and then because of poor exit decision, now it is back before even the COVID highs. So stock will decide how strong is it. You can only write the trend. Now on weekly chart, if you ask me, some stocks will give you 10 times move also, Tata Elxsi. Some will give you 7 8x, Laurus Lab. Someone will give you like Deepak Nitrite from 300 400 level to 3000 level, 7.5 time move. Some stocks like Aditya Birla Fashion, they will be a slow mover, like they move up maybe 50 60%, then they break down. So you can ride the trend as long as the stock is healthier and the stock is stronger. So there is no fixed time frame, but yeah, exit is very important. So when you get the trend reversal signal, you have to exit. Now there are many stocks that have not corrected, like KPIT Technology is still in a very healthy trend so far. So many stocks, as I said, like they move up 2x, 3x within a shorter time frame, and then they give back up all the gains. Like you see many PSU bank chart now, or maybe railway stocks, they made a move. Now you will see whether they continue the move or they fall down on the charts. And then you see what happened with Musdoc now. It made a move till 900, 950. Now you will get the exit signal. You have to get out somewhere in the middle. So my portfolio approach is 50 60%. I always have passive investment, so that's what I recommend to everyone also. Have some passive investment for peaceful long term wealth creation. With remaining capital, I do swing trading. And in swing trading, if stock is healthier, I may sell some portion, and some of the position size I will free roll. Like I may sell half to recover my stop loss cost, and then I will trail it as long as it goes. So that's how I do. And
So,
market, if market is coming from deep crash or correction, then I will love to hold stocks positionally for a bigger move. Hmm.
so Himanshu, is like a certain percentage you allocate, or depending upon the strength and your conviction you allocate. So there is no upper or lower limit as such.
The allocation is dependent on where my exit is. When I'm taking entry into a stock, I know beforehand this will be my exit point. If the stock breaches this level, I will be out. So now if that breach point is, let's say, 6%, and if I have to risk 1% of my portfolio, I can go on with a size of 16% to risk that 1%. So I can then maybe start with 8% position, half position, and half I may buy when the stock makes a move in my direction. That's how I pyramid up. So percentage allocation is dependent on the chart structure. The uh, closer I am to the stop loss level or the failure point of a stock, the closer I can time my entry, then the bigger position size I can make. So it depends on individual chart stock individual stocks chart structure.
So, Himanshu, let's talk a little about the stop loss thing. So, is there any set percentage, or it depends on the, I mean, how, because in certain stocks they have different kind of volatility. So, on the basis of that, you decide the stop loss. And on top of that, a very important question which comes to my mind is like how you keep emotions aside, because when it comes to booking loss, when the trade doesn't go the way you want, it is a very difficult decision, and most of the people lose money owing to this situation only.
So, stop loss percentage, like what you are talking is the fixed percentage. That's called money stop, where you decide, okay, this much fixed percentage I will keep my stop loss. So stop loss is decided by the structure of the stock. So if I am taking entry, if it is a highly volatile stock, I will skip it. I don't trade highly volatile stocks where they are falling all over. I want a peaceful, calm stock. I mean, not peaceful in a way that it doesn't move. I mean that before it starts to move, it should calm down. Like ITC around 270 or 271. If you look at the chart, you will get what do I mean. The stock calmed down near that 265 to 272 zone. So that's where you will time your entry. Now that stop loss is dependent on what very very it depends on the technical structure of the chart, I should say like that. Technical structure on the right hand side of the chart. As far as emotions is concerned, now I also face this same problem. Like many people face, I would hold on to a losing position. Uh, then what happens? You have to maintain a trading journal. That's what I repeat in many of the tweets. Whatever you trade, just note down somewhere. Note it down somewhere, and then I have a practice. After 1 month, I take a trade. I take the printout of all my trades, the charts, after 1 month, because now I know how well the stock performed. And also when I'm doing analysis of my trade after 1 month, now I'm much more aware. I'm not biased. If I'm doing the analysis the next day, I will be biased. So I take a gap of 1.5 month. The more you uh, analyze your trades, so in initial days I was making losses. When I analyze my trade, then I got to know, okay, this is the wrong entry. Here I booked my position too early. Now here I sold it very late. I could have saved my money. So as a trader, as an investor, your hard earned money is the inventory for you. So it's a serious business. So you won't see big companies in India losing their inventory like that. Nobody loves to lose their inventory. So that capital is your inventory. So if you lose your inventory, how will you do the business? So to stay in the business game, you have to uh, log in your trade journal every day, or maybe every week, or whenever you take a trade, just log it down. Second thing you can practice is you can have automatic buy orders. Many brokers give you that facility. You can place an automatic buy order once you analyze a stock. Okay, at this level, when the price crosses, I will buy. You can place an automatic buy order. And whenever that automatic buy order is clicked, you will get a notification in your mobile phone. These days, you have technology. Sometimes I do that. And then I place a stop loss from my mobile phone and then don't look at the market. So there are all kinds of traders. I'm telling you, if you see Mark Minervini, Sir Mark, he's always in front of the screen. Whereas you read about Sir Nicholas Darvas, he was traveling, he was performing his shows, he never saw the market. In fact, when he went closer to the market, he started losing money. Sir William O'Neill always uses weekly charts. He was not completely on the screen always. So there are all kinds of traders, all kinds of traders. So do what suits you. So these are two important way: trading journal and automatic orders that can control your emotion. Don't just sit in front of the screen that time. Mhm.
Right. So we have one speaker with an ask.
Mhm.
Manish, you are still on mute.
Sir, I will just ask one or two questions. मैं हिंदी में पूछूंगा। सर, आप जब भी ट्रेड करते हैं, आप कोई ऐसा आपका कोई फिक्स्ड है कि इस मंथ में मैं नंबर ऑफ स्टॉक्स इतने पोर्टफोलियो में रखूंगा, उससे ज्यादा नहीं करूंगा? और दूसरा, कि क्या आपका कोई मंथली या वीकली स्टॉप लॉस भी रहता है कि मेरे पोर्टफोलियो से इतना लॉस होगा तो आई विल क्विट द मार्केट, आई विल नॉट ट्रेड इन दिस मंथ?
सर एक्चुअली मंथ का नहीं रहता है नंबर ऑफ स्टॉक्स। मैं पर्सनली 8 और 10 से ज़्यादा पोर्टफोलियो में नहीं रखता हूँ। और होता यह है कि नंबर ऑफ स्टॉक्स, जैसे इफ यू आर सिटिंग इन 100% कैश नाउ, लेट्स से फॉर एग्जांपल, नाउ market turns healthy, you will be testing out some position, like you will buy 2 or 3 or 4 strong setups, and then they will tell you whether you have to add fifth or sixth or not. So by the time you are fully invested, that means the market is healthy. So there is no fixed month to do that. So fully invested means 5, 8, or maybe maximum to maximum 10 positions open. And some will be losers initially. You will book the loss. You'll keep the losses smaller, pyramid up in your winners. So there is no fixed rule for the month. And yeah, obviously, drawdown. Now you're asking monthly, weekly, if the portfolio draws down. Now you are going into the market when the market is strong. Your trades are telling you. So you are sitting in gain right now. And when your stop loss is hit, you get out. Now, for example, you enter with 4 stocks. What beginners do the mistake is they immediately buy 10 to 15 stocks and fully invested within 10 minutes. Now what happens? Stock market corrects, and then they get out with 10 and 15 stop losses hit. and they lose 4 or 5%. So in this strategy, when you go in with slowly 3-4 names and then increasing the allocation as you get profit from the first 3-4 positions, in this approach you are always in the healthy market. And when the market corrects, you may book some gain or you may be getting out at break even, but you will not make a big loss of maybe 4 5% or maybe 10% of drawdown. This you won't make in this strategy. So that's why start with one or two or maybe three stocks, and then when the market turns healthy, you can increase your exposure, increase your allocation. And if those trades are not working for you, you will automatically reduce. So I mean, no fixed number of portfolio drawdown kind of percentages.
Okay, one more question, sir. Sir, should the beginners trade with the Nifty 50 stocks? Should they track the Nifty 50 stocks first and then move to other stocks?
Sir, Nifty 100 is good for a beginner. 100 charts are enough. Uh, Trading, I mean, yes, you can practice on those charts, Nifty 100, but like it depends on how much time can you give. So if you can give time, I would be trading maybe Nifty 100 or maybe Nifty mid cap 150 names. So these 250 chart setups. Otherwise, for a beginner, Nifty 100 is enough for practice. But in Nifty 100 also, these days we have some funny names in the market now. So you have to be very careful in your stock selection, even within those 100 stocks, total stocks.
One question more, sir. How to
Yes.
filter the list of stocks? Any person can't track all the 100 stocks or the 50 stocks. How to filter out? How do you filter out?
Sir, if you are trading only Nifty 100, it takes less than 30 minutes to scan for 100 stocks, like or see all their charts 100. It will take just 30 minutes. But yeah, if you are asking about the complete market, I use relative strength, the stocks that are performing better than the benchmark. So there are many good scanning softwares available. I use MarketSmith India, and that's how I scan. I use the relative strength and relatively stronger stocks. They are roughly about 200, 300, and then I go through their charts manually. So if you are just tracking Nifty 100, then Nifty 100 manually is very easy, sir. So you can make it a habit of just looking their chart. Initially it will take time, but later on the time will be reduced to just 30 minutes or maybe 20-25 minutes maximum.
So Himanshu, like there are some questions in the comments. I read it out for you, and we take your answers then. So his one is from Anubhav Srivastav. He is asking, my question is related to learning. Please guide how long you took and how you went through the learning process.
Sir, it depends on my process was like you are also working, sir, in Noida. You come from a very far away place, 2 hour journey one side. For me, it was 1.5 hour total traveling time from my office to my home. So I was listening to interviews. I was spending many nights reading books. So it took I can say, see, sir, in market, everyone is learning till today. So everyone is a learner. Disclaimer, I'm still learning. But if you ask that basic foundation part, it will take initially 1 year, 2 year. But the more you practice, the more you see the charts, the more you will be better at it. There is no substitute for it, because every day market will throw up new things, new concepts. So you master them, you learn from the market, and then slowly and slowly in your brain you see those. Whenever you see a new chart, you will immediately recall, oh, this happened in that particular chart. So that's how the things will get connected. So it it's a constant process. But yeah, for the foundation part, it will take somewhere around 1.5 year minimum, not less than that.
So Himanshu, let me put this question this way, because when we speak to different technical analysts, so they have different kind of I mean, not different kind of, but different book names or authors, which they and there are always personal liking or personal biases maybe. So, is there any way like which book we should start with, and then we progress to next book, so that the literature can be covered? Because people are clueless, they end up buying many books, and same happens with me, and they are, I mean, just piling up. And is there any way, or it's like hit and trial? You study and you find out your niche.
Uh, So in technical analysis, firstly, technical analysis is a broad principle. It's used for investing also, trading also, hedging also, then many intermarket analysis also, algo system testing, system design, so many things in technical analysis. It's a big field. Now, I am assuming that people are asking how to trade and invest simply. So, if their question is about how to trade and invest, then number one book they should read is by Sir Nicholas Darvas, How I Made $2 Million in the Stock Market. That's a very pretty thin book. You can cover it within 2 or 3 days. That's important book number one. Number two will be, you can read How to Make Money in Stocks by Sir William J. O'Neill. That's for kind of a positional trading, can slim approach. You read How to Trade in Stocks by Sir Jesse Livermore. These three books are very important. Now coming to that hardcore part of technical analysis, which gives you the basic about chart patterns, candlesticks. Then you can read just one book by Sir John Murphy, Technical Analysis of the Financial Market. So that one book and these three. But you start with Sir Nicholas Darvas, Sir William J. O'Neill, and then you read How to Trade in Stocks by Sir Jesse Livermore. And if you are expert now and you are going ready to go into maybe the lower time frame also, because these books are kind of a broad overview, and then when you go deeper into it, then maybe Sir Mark Minervini's book, two books written by him. But now, if someone has stamina left after reading this, I would recommend the work by Sir Richard Dimilvikoff. Now he has written plenty of books. You can start with Method of Trading and Investing in Stocks. This one book, I think 1932 or 1933 he wrote the book. For I know many people love to buy stocks that are falling, so they they want to identify a market bottom. When the stock made a bottom, actually they want to buy exactly around that zone. Then Method of Trading and Investing in Stocks by Sir Richard Demelvikoff, section number 7. So the book has many section, not chapter. Section number 7, page number 3. If you read the book, he starts with one example when he take the chart of a stock from 8th December to 19th December, what happened, and then what happened. So that chapter onwards will be very helpful for you.
That's a great list, and I would request if sometime down the line you have a tweet on this. And also, like Himanshu would appreciate if, as you progress as a, I mean, in the trading or investing journey, do consider writing a good book.
Yeah, sure.
So Himanshu, there are plenty of questions I'm reading out. We are good on time, right?
Yes, sure.
Haha. So Make Me Investor is asking, sir, when seeing a weekly chart, should we enter and keep stop loss according to weekly or daily?
Sir, it depends. Where are you entering? Firstly, I am assuming that you are entering maybe at the breakout. So sometimes the weekly candle is huge. So your stop loss will be 15-20% deep also. I don't recommend that. In those cases, you can then shift to daily chart to place your stop loss. But if the weekly candle is sufficiently giving you stop loss within the range of 8, maybe maximum to maximum 10%, too rare 10%, then in those cases you can put your stop loss based on the weekly candle. So it depends on how far your stop loss is. But if your stop loss is 15%, 16%, and I mean, that's a huge stop loss. So even in those cases, but I cannot come to your computer screen and stop you from buying, you will still buy. So in those cases, you have to control your position size. So position size should be less than what you were intending to buy, so that you make still the similar loss that you would have made if the stop loss was 8 or 9%. Hmm.
Right. And for the attendees in the meantime, like do follow us guys, and that gives us the motivation so as to bring your favorite people and learned expert to share their views. And also check out handle of Himanshu. You will surely gain so much of knowledge, and the books which he just mentioned, surely will request him to place a tweet over that so that you guys can refer to that. And one by one I'm taking your questions. Please don't ask any question ki next stock kaun sa chalega, next week mein kya hoga. We won't answer that. So Prashant Sahai has a question. So what is preferable time frame? That is question one. And stock selection process in mid and small cap section. Prashant, I think second part we have covered. Selection process is same for small and mid cap, I guess. Yeah, Himanshu.
Correct, correct. So that same. And what first question was what? I missed that part.
Preferable time frame. Maybe he's
Preferable
asking
time
daily.
frame. Okay, okay. So for investors, monthly and weekly, not beyond weekly. Not Don't go to the daily chart. Maybe when near the market tops, you see some sign that your stock is unable to move up even after many positive news like Saregama uh, or CDSL. Number of demat accounts opened 3 CR, 4 CR, 5 CR, but the stock fails to move up. That time maybe you can go to the daily chart to just check what is happening. But for an investor, like you are sitting in a aeroplane and you are watching the surface of the ocean, so monthly chart, and then you come a little down, you look at the tides. That's your weekly chart. Don't look at individual ripples in the ocean, on the ocean surface. That's headache for you. Daily volatility for swing trader, daily chart is enough. And that's the preferable time frame, sir. Daily, weekly, monthly, but monthly and weekly mostly for the trend followers, and weekly and daily for the swing trader. Weekly for swing trader to understand the zone of supply, zone of demand, and then on daily they will make their entries and exits. Hmm.
So Himanshu, one question appears pertinent to me. So he's asking, does it make sense to see weekly charts during week because current week structure is incomplete? So perhaps before weekly close, that week structure is incomplete. That is the question, I guess.
While the time of entry, sometimes for the time of entry, you should definitely look for the daily chart only that period of time. Like you have decided the weekly chart, you have selected some stocks. Now you know this is the breakout level, or here I have to buy it. Now the stock may break out on Tuesday, and you are waiting till Friday. It may be possible the breakout level was 150. You saw on Friday the stock is sitting at 220. I have seen plenty of cases like that. The stock moves up 20-30% and you miss the opportunity. So it's better when because see, transactions are taking place every second, every minute. Stock doesn't know you. These transactions are recorded on the software, on the platform. Now it's your uh, comfort level that you have selected weekly chart, but the transactions are taking place on Monday also, Tuesday also. So it may be possible that Tuesday your level where you decided to buy the price, the stock closed above it on Tuesday. Maybe you can take an entry on, maybe half entry on Tuesday, or maybe some entry on Tuesday, and then you can wait for Friday closing and you can enter remaining shares on Friday. Now it depends on you how much patient you are, how much conservative if you are. If you are waiting for the closing, I already told you sometime the disadvantage is that the stock may be too high from your buying zone. And while the time of exit, uh, weekly, you see that, see, any healthy stock should not have distribution sign near the top. Now if I mean anything that goes up, it doesn't goes up forever. So it has to correct it. Some stocks, if you see, if you, for example, now I am giving you many examples. For example, Adani Enterprises, let's say that's not Adani Enterprises, that's any other stock, ABC. You take the decision based on weekly closing to exit. Now the stock on daily, Monday, Tuesday, Wednesday screamed to you that I am getting weak now. It has breached all the level. Your exit point, let's say, was 700. On Wednesdays, the stock is at 600. So will you wait for Friday closing or will you exit? So again, it depends on traders to trade, investors to invest. Some are conservative, some are aggressive, some are having moderate stance. So I usually prefer exit and entry based on that daily chart, but yeah, exit will not be much trouble on the weekly chart in many cases. 8 out of 10 cases, you can get a pretty much decent exit on weekly closing. But sometimes in those two cases out of 10, you will get a brutal fall, the vertical fall. So you may lose your investment. So have a stop loss at a pretty much far distance, maybe 10% or maybe 5% away from your exit level. You should have a stop loss to avoid that vertical fall.
So, what's your method to gauge the overall health of the market? So, how you go about checking it, and how you place yourself on the basis of macroeconomic factors?
So macroeconomic, to be honest, I don't consider at all. Like I tweeted once, I'm sitting in a very isolated small room, so there is no news access. I don't read news. I don't know most of the time. Like for past 10 days, I'm blank. So now whatever news is macroeconomic news is there, it will be visible on the chart, because if it is positive upcoming within 1 month 2 months, if the news is positive, that will show up in the transaction of the big buyer. The price will move up with good volume. Otherwise you won't be seeing these false breakouts and the stock falling down back. So news will be reflected on the price transaction, because that's the second point of Sir Dow's theory. Price discounts everything. So uh, you will get here that macroeconomic, I don't track. For gauging the health of the market, there are multiple tools under the tagline of market breadth. So number of stocks above 50 days moving average, 200 days moving average, you can track constantly. Advance decline ratio, you can track how many stocks were advancing, how many stocks are making new highs, how many stocks are making new lows. In a healthy market, you will see new highs are far more than new lows. And then you can spot for divergences. You can, in a weaker market, or when the market is near the top, you will see false breakouts, you will see climax stops, you will see accelerating trend line, which is yet another way of climax stop. The stock makes a sharp move and then gets sold off vertically. And then you see sentiment factors, like market will be in extremely bullish stance. There are multiple surveys being conducted by, in America, we have AAII, American Association of Individual Investor. They conduct many surveys. So sentiments will be overly bullish. Now you have to look for the charts of the leaders. The leaders will stop moving up. Uh, on positive news, they will fail to move up. So those are the first sign. Leaders will start breaking bill down. Now you see the chart of Amazon in July, massive gap down. So that's how these are 8, 9 parameters. That's how you track the health of the market. But just to add that if you do that manual scanning, if someone has decided that he or she has a lot of time on weekend, can scan for all the listed stocks in NSE, National Stock Exchange. They are roughly about 2000. And then nothing better than that, because you can track maybe Nifty 750 stocks, the top one. So nothing better than manual scan. You get a feel for the market. So if you do it maybe every day, not possible for, or maybe once or twice every week, nothing better than that. So all these factors that I discussed are coming from these 750 stocks. Mhm.
Great, great. And like we got so many comments regarding the recording. The session is recorded, and for your convenience, I have pinned a tweet of YouTube channel where I will be uploading this after the session commences. So another question is from RG Chart. Himanshu is asking like, how do you trade stock with low float? Let's say the setup is good, but the shares that are getting traded is too less. If I want to buy in bulk quantity, I am already losing nearly 1%. If I keep stop loss of 2 to 3%, it hits most of the time. I prefer trading small to micro cap only.
Sir, actually, low float, firstly, the shares are cornered by promoters, or maybe bigger houses. They have cornered. So low float means maybe the floating share in the public maybe 2%, 3%. But understand it that low float and volume are two separate things. So even though the stock is low float, still you may see the volume can be higher, maybe 1 lakh shares traded, 2 lakh shares traded, because the total number of shares of the company may be huge. Now coming to uh, the low float or high float concept, I am just focused on the volume. So I tweeted one stock like Went, WENDT. If you check the chart is good, chart was okay, everything is good, but I will not trade because the number of shares traded are 500 to 700 only. So minimum rupee volume, if you ask me, 5 CR I look for. Like maybe 2 CR, 5 CR should be the actually the minimum rupee volume. If you see maybe the number of shares traded, 10,000, 20,000 minimum I look for. And if number of shares traded are 100, 200, then there will be slippage issue. What is slippage issue? You want to buy a stock at 140, but you will get it at 146. When you want to get out, it will be very difficult. So within your broking platform, you can just see the buy and sell, bid and ask prices for that stock. So if it is highly tradable like ITC, you will get your orders filled in very easily. So volume will tell you that figure. Now, sometimes I trade some stocks like they have very less volume during the daytime, and by the end of the day, the volume spikes up. So I have to skip those stocks also because the volume trade is just 2,000, 3,000 shares. So you have to focus on the volume. Even though the float is less in some stocks, volume may be high. So number of shares traded, that is the important criteria. So if it is less than 5,000, 10,000, I get worry of it. So I usually don't trade them.
So next question is from Shivaraj. Do you use GAN lines or any other such
No,
lines?
no, sir. I don't use GAN line. Uh, that's what his question is. What I said that in technical analysis is a vast ocean. It has GAN line, sir, GAN's theory, WD GAN. Then we have time cycles also in it. We have a book written by Sir Garrett, Torque Analysis of the Stock Market. There are many things in this market. Elliott waves, Dow theory. Do what suits you. I don't do it. I just know the basic uh, idea of GAN theory, but I don't use it. I just keep it very simple.
Right. So what does it mean if the price is not moving in a very big range similar to current structure of XYZ company?
Okay, so price is not moving in a very big range. Okay, so you have to first see how long the range is. If the range is of maybe 6 years, 7 years, like BPCL, if you check the monthly chart of BPCL, it has done nothing. So now coming to the second part, if the range is for maybe 2 month, 3 month, then you have to constantly look for the left side of that range. How well the stock performed, is it coming from top and then forming a range? Then the chances of breakdown are very high. And if the stock moved up strongly on good volumes and then it forms a range, very tight range, and then it crosses higher, then it is good buy. And also sometimes these very tight range, I know maybe he's checking the chart of DFM Foods. So that sometimes due to some corporate action, the stock is artificially floating in a very tight range, like DFM Foods, and before it was Escorts Kubota, before it was Butterfly Gandhimati. In those charts, you have to understand whether there is any corporate action or not. Other than that, I already explained range. The prior price action before the range will tell you what to do after the range. So don't look just at the range or the base. No, you have to look for the price structure on the before the base formation.
Right. So Himanshu, like there are questions around how to strategize a 9 to 5 job and the people who are into 9 to 5 job, and some questions are around like how you manage to keep in cash and there are turbulent times. So for that, I have small input for our attendees. Like, see, first of all, you have to identify yourself what you are good at. You have to devote time, be it 9 to 5 or maybe you are take decision of leaving your job just on the basis some other person has done that, because your situation and his situation are totally different, and market is like it will remain, right? There is no hurry that you have to earn everything in a short span of time. Take your time, learn the nuances, and take your time and identify your niche. So any input on the same question, Himanshu, because there are some questions, so I thought it should be told to them.
So when I teach, still many people ask me like, I want to leave my job. That's what I said. No need to do that, because you are just considering this field to be an adventurous field. It's Nobody talks about the psychology that goes through the process. You are sitting in a room, no interaction with anyone. 9 to 5, what will you do? Now trading hours may be extended till 5 p.m. What will you do from 9 to 5? It's a hard psychological what if 5 or 6 trades give you loss in sequence? You don't have, now the financial capital is now getting down, your mental capital also getting down. So that's why I said read the book How I Made $2 Million in the Stock Market by Sir Nicholas Darvas. He never left his work and still he made money. So it's you these days you have technology in your hand. You can set up your price alert, you can do your homework on weekend, and you can set price alerts for your selected stocks. When that crosses, now you can put in buy orders also. Automatically machine will buy for you. When that buys for you, you can place a small stop loss, and this way you will trade much better. So it's very easy to make money on weekly chart when the market is trending. No need to leave job for that purpose. So weekly chart, read those books. Sir William O'Neill, you pick up his book. He never used daily charts. Always weekly chart he is tracking. So that's how you can see many traders have made money in their own style. Some have made money through swing trading. You will see some successful intraday traders also. You will see some weekly chart followers also, trend followers also. You see Sir Warren Buffett, who never saw the chart. So there are all kind of trader and investor in the market. Many have made money. So no need to leave the job for trading per se.
Yeah, great. Well said, Himanshu. So, Himanshu, there is one question: does market breadth indicators work in sideways market as well? And on top of that, I question when you decide to keep outside market or maybe keep a larger cash position. So, what are the basically pointers you look for? Or
So, market breadth, firstly, you have to understand it is telling you the health of the market. Any market breadth indicator, you pick up new highs divided by new lows, the Norman Fosback high low logic index, it is called. These indicators are available in the market. They are just telling you the health of the market. That's what I'm saying. You manual scanning is the best option. 750 stocks if you can do on weekend, because what happens when you join any college or school, you do not know the names of any classmate. Now after 6 months, you know their behavior, know their character, know how they do or act in certain situation. That's what you do when you live with your stocks, when you see them manually. Now market bet indicators, as I discussed, 7 or 8, they will just tell you health of the market. Now what happened, I was holding 8 stocks in October 2021. Now, in the third week, 6 stop losses were hit. Now, market is telling me to get out, to sit out. Now, breakouts are not working. So, when you are trading, even in this market, you see now the stock structure of many charts. Uh, you buy the stock at the breakout, the stock moves up and falls back in. So, what is it? The market is screaming to you that I'm not healthy now. So, these market breadth indicators are secondary tools. Some people track 20 MA, 50 MA. You can do whatever you want to do. Manual scanning is the best option. Second, market bet. Now, in the third week of October, go and check the candle of Indian Energy Exchange DMART CDSL on 18th October 2021. A market had climax top in most of the names. False breakouts were there. So it's screaming to you. So that's why you have to sit out during those periods. Now, 6 out of 8 stop losses were hit. I was out. That's why Sir Nicholas Darvas writes in his book, I decided to let my stop loss decide. So if you have stop losses in the system, automatically they will save you from the market fall. So on 29th December, I tweeted that I am now sitting in 100% cash, because nothing is working in this market. It's very difficult. 2 out of 10 stocks may work. And then when you see rocket flying on Twitter, you will think, oh, this man is making money, I will also buy. But at the time of buying, you do not know whether this stock will work or not. Only in the hindsight, you know, okay, this moved up 40-50%. And in that process, you get your 8 stop losses hit. So you will have your winning percentage going down.
right. So Ambili Mama has two questions. So, which one is best in relative strength filtering? Is it the one moving up from negative to positive, or the one which is already in positive? And second question is like how to take a call if a stock has positive relative strength, but relative strength is coming towards the zero line of RS.
See, maybe what is he using is the trading view screener, which shows the zero line and RS is in the negative territory or the positive territory. That's what they are doing. I mean, I think they are using that indicator. Now, that's also a better option. But what happens? That's a bit complicated. That's why you need some softwares that throws out a list of stocks in descending order of strength. For example, I have 6,000 stocks. Now I see how well they performed over a past certain period and how well the benchmark performed Nifty. So then I will arrange those stocks in descending order, and I will just look at maybe top 20% or 30% names. Now you can uh, do this every day. No, I'm not saying you to do it. Software will do it for you every day, and that's how they draw a line. Okay, any stock that is now performing much better than past 3 days, 7 days, 14 days, their line will move up. So definitely you want to see the relative strength line moving up, and any stock that is the price moving up but the relative strength is going down, that's again a negative signal. So that indicator which he or she is talking about, RS line crossing the zero from the below or from the top, I don't use that indicator. I just use the basic relative strength line from MarketSmith that uh, filters out the stock in descending order. That's what I do to keep it simple. So once you focus on top 30%, you get their names. Now it's the individual chart structure you have to study. So RS may be going down for two stocks, but one may be in a range that may break out and other one may be breaking down. So RS is only the first tool. Second tool is your individual chart study.
Right. So AGMG has a question, quick question basically. Price volume chart of how many days? 5, 10, or 20 days?
Now, price volume chart, like if you're a positional trader, as long as you can see it, it's better because you have to see the complete picture. If you're an investor, you will be looking at a long term chart. So, weekly chart, if I'm tracking, I usually see the 5 year past data, but only recently, if I see volume spikes on the chart, sometimes the stock is going down. Like BSC chart, if you open, so sometimes the stock is going down, but now you start seeing spikes in July or September 2020. So that's where it will catch your attention. So maximum data which you can track, the maximum you can track, it is better for swing traders. Yeah, maybe it's a short term price data enough, maybe 1 year, 1.5 year, because you want to see where is the zone of supply and demand. But that's a very simple. The simple answer is that the more is the price data on your screen, the better it is, because you want to see the whole train from where the train is coming, not only the one uh, coach of a particular train.
Right. So one interesting question. So how you decide your stop loss in swing trading on closing basis? If it hits your stop loss and cross the high of that stop loss hitting candle again, will you enter in that stock again?
Or stop loss, I decide on the trigger basis. When the stock touches the my stop loss, I'm out. Now, see, I don't know, will you believe or not, but in most of the cases, I have practiced enough that those are the zones where the stock decides the direction. So if it hits the stop loss, I am out. Now, if the stock hits my stop loss and you are saying it moves back up to the stop loss day high, so you mean that stop loss, which is 6% deep, the stock fell down 6% exactly and then moved up 6.2, 6.3% back up to the high. So I have very rarely come across these situations, because usually when the stock breaks out, let's say I place a stop loss at 6%, within the same day I haven't seen the stock hit going back down and then moving back up. I hope you're getting my point. That happened. For example, I'm giving you an example. That was not my trade. ITC stock on the budget day. You are talking about these kind of moves where there is a shakeout candle, or maybe the stock goes down and then moves up. That's why I'm saying in this space, I said you always buy in the direction of the trend when the price is moving up. So when it crosses the resistance, it moves up, I'm buying there. Now if you say that if it goes back to hit my stop loss 6%, then I am out. And within one day, if it moves back up 6.2, 6.3% to cover that 6% fall, then I won't be looking at it immediately, because that stock has now turned highly volatile. So I won't be looking. I will be giving it maybe 3-4 days of time, but usually very very rarely. I'm telling you, I don't remember exactly except ITC and one trade of Anantaraj when there was a free trade. Other than that, I don't remember in my trading book any trade like that which hit my stop loss and immediately crossed the high. Mhm.
So Himanshu, like there are questions around margins and leverage. So do you prefer that? And additionally, like do you short sell also?
In short selling, I have to take leverage. I do short selling. In previous space also, I was having Crompton Greaves. I discussed in that space, I was having short position in it. So I do shorting. In shorting futures, I have to take leverage. Otherwise, cannot short in that inter. But shorting, but leverage, I recommend if you have practiced enough for 2-3 years on the charts and capital is size is good. Otherwise, short leverage will be acting as a double-edged sword for you. So for shorting, yes, I short. Shorting is just nothing but trend following to the downside. So you are following the trend to the downside. Uh, so yes, I short sell also.
Okay, great. So there are questions around the patterns. So I read it out and we also discuss about the patterns like cup and handle and all. So should we trade all time high stocks, which is on move and wait for consolidation in it for breakout? Example, I trade cup with handle. So if a stock is all time high and it forms cup and handle breakout, I don't want to trade down reversal breakout.
Okay. So like for example, KPIT was one chart. Maybe he's discussing about KPIT also, a cup and handle kind of breakout in last week of January. So yeah, all time high cup and handle pattern. I mean, it's a see, you have to understand again where your stock is. Is it a cup and handle breakout for the first time? Open the chart of Deepak Nitrite at 575 after COVID. 575 Deepak Nitrite. If we open, that was a cup and handle breakout. Now, that breakout is the first breakout after that COVID fall. Now the stock recovered back, broke out at 575. Now here I will be aggressive because it's coming from a deep correction and the stock made a beautiful chart pattern which signifies shifting of stocks from weaker hand to strong hands. But at KPIT, I cannot be bullish to that same extent because now KPIT has already made a move of 500, 600, 700%. So it's a very volatile cup and handle. So yeah, you can trade all-time high stocks or maybe 52-week high stocks, but better to buy them as they are breaking out for the first time or maybe the second time when they make a move. Not like when they have already moved 500, 600%. So that those patterns will be very volatile. Mhm.
Right. One question is, what do you think of MFI instead of RSI?
So MFI, money flow index, OBV, on balance volume. Then you have see these are coming from your. So MFI has a formula. If someone is interested, I will be mentioning in the post somewhere. Money flow index, on balance volume. These all sort of commodity channel index. They are derived from the volume in here, price and volume action. See, any indicator is derived from the price and volume, so it will always be lagging in nature. Now, there are many chapters in the book: leading indicator, lagging indicator. What do you mean by leading and lagging? Now, they say leading, it tells you about the price in advance. No indicator has been. See, you are calculating the value of that indicator from the price or volume. So, how can it tell you in advance what the price will do maybe 7 or 8 days later? You can just forecast it. So, money flow index, just like on balance volume, CCI, it's just one tool in here. So you can obviously use it just like I told you, to spot the divergences, to spot the market top. During the market tops, the money flow index will be very, very high reading, and then it starts breaking down. So these all indicators are like secondary tools. So that's why I don't track them. Mhm.
So there is one question. Are the same principle work for index trading positional? And do you do index trading? And can we apply this for future trading as well?
Yes, same principle you can apply. Same. Technical analysis works in freely traded securities. Any security that is freely traded. It shouldn't be like you went to Kenya and buy one stock and you are the only buyer. Whom will you sell it after 10 days? It should be freely traded, so it applies on cryptocurrencies, commodities, indices, ETFs that are freely traded. You pick up any ETF of America like QQQ ETF, semiconductor ETF. All these ETFs are pretty much traded in high quantity. ARC ETF, innovation ETF. Similarly, in India, all the indices you see, Nifty index, you'll see all these concepts working on the index level also. So yes, you can trade on index level also. So if you see a breakout in the pharma sector, right at the COVID low, pharma was coming from 6 years of downtrend, 2013 to 2019, it was heading down, then it broke out after the COVID. So if you are not a good stock picker, you can buy a pharma ETF so that you have a basket approach. So PSU banks were breaking out a few months back, you can buy PSU Bank ETF. So same approach works on index chart also. You can track these indices. They are freely available on niftyindices.com. Nifty Infra Index, S&P, BSE Oil and Gas Index, then PSU Banking Index, Private Bank Index. We have almost 10, 15 healthcare, pharma, FMCG, all these indices. So you can apply the same principles on index also.
Ravindra Rao has a question. Does it make sense to place your stop loss based on ATR or always a percentage below your buy price?
So ATR, I would never recommend. ATR is average true range of a stock. Now ATR I usually never recommend whenever I teach also. ATR means that what is your range of the stock for the past 14 days. Now when your stock becomes too volatile, the range will expand. Now when the range expands, your stop loss was, let's say, 1.5 times of ATR or 2 times of ATR. Let's say when you buy, the stock range was 20 points. Now the stock becomes volatile. Now the range of the stock is 60 points. Your stop loss is 2 times ATR. So previously your stop loss was 40. Now your stop loss is 120 points. So you are telling the stock to tell you where to place the stop loss. So that's not an intelligent decision. Never do this mistake. That's my personal opinion. ATR stops are decided by the volatility of the stock. So that is a very dangerous situation. If your stock, let's say your stock makes a move of 50% within 3-4 days. Now range expands. So range expands 5 times. So 2 times ATR will be your 10 times now stop loss of initial level. So you will miss the entire gain when it corrects. So that's not an intelligent decision.
Right. So, sir, do we consider the basis where there is already rejection candle above the breakout level?
Oh, rejection candle above the breakout level. Okay. So these are series of violation unless your stop loss is hit. See, he is now going to the he or she is going to the violation level. Like after the breakout, then there is a rejection candle. Means the stock, a rejection candle uh, can be the stock pulling back, or the rejection candle can be 2-3 days the stock came down. Then you have to give stock the time to react. If it bounces back up again, it is strong. If it fails to bounce back up or crosses or just reaches the same high level and falls back, it is a violation. On the chart of Costco in America, Nasdaq, just the recent example of Nasdaq, check the chart of Nasdaq now. It moved up after the breakout, then you have a rejection candle. Then on the daily chart, if you see Nasdaq, and then it failed to move back to the new high and then fell down. And Amazon in July 2021, there are many examples. Biocon at 330, 340, I remember. So rejection, like, yeah, but after the breakout, pull back and then bounces back up again, very strong. After the breakout, pulls back, bounces back, fails to move to new high, and again falls down. Very negative sign, very negative. So in those cases, you can sell even before the stop loss is hit, or you can trim your position in those cases.
So Himanshu, some questions for people who are mainly into fundamental analysis, like how much fundamental analysis find place in your investment process? On the top of that, like if the fundamental guys have to refine their sell strategy, what would be your recommendation? And like we often hear from different people, like it's very difficult or it's fruitless to marry fundamentals and technicals. So any view on that also?
No, sir. See, for fundamental exit, I said that a long-term moving average, maybe 40-week moving average. I did a complete webinar with Ishmohit also on the same. You can read a book by Sir Stan Weinstein, Secrets for Profiting in Bull and Bear Market. You can write the complete trend with the moving average. As long as the price structure is intact, making higher high, higher low, and the moving average is sloping up, you can ride it. Now, the second question is marrying the fundamental and technical. Now, again, I'm constantly busting this myth that people say technical analysis, fundamental analysis, both are like maybe some different fields. See, you are a fundamental investor. You researched about a company. You think that the company is fairly valued or undervalued. The stock has a bright potential. What will you do? You will buy the stock. And before you, mutual funds, institutions, if it is a known company, they will buy. If it is an unknown company, you will buy and the funds will come in later. There are only two possibilities. Either you will buy first or they will buy first. So when the stock is in heavy demand, that volume is visible on my chart. That's what I said. Open the chart of Carisil now. I don't know the news, but I am always sure that price moving up with good volume always has some upcoming news. So when Carisil broke out at, now it's an split or bonus adjusted price at 170, from 140 to 170 80, Carisil, the name was Acrisil that time, moved up. Company received a global contract from IKEA to supply quad sink all over the world. Now that's fundamental news. When Tata Power crossed 90, fundamental investors came in and they said they will be giving these solar charging stations here and there. Now at 60, even at 40, 50, 60 level, the price is moving up with huge volume. That's not retail buying. So whosoever is buying that time, he knows already that fundamental research in advance. So that's how you have to think that technical covers fundamental indirectly. Now, second thing, if you do not exit, then you see many stocks. You see in America, Zoom, Peloton, Roku, DocuSign, and then you see in India, Sequent Scientific, then many stocks, they moved up 500, 600%, and then came back. So if you do not book your gain, people think our compounding will be affected. No, you can take out your profit and you invest in another opportunity. That's portfolio churning, even done by fundamental investor, renowned fundamental investors. So I have nothing against funda. All I am saying is that I use 5% fundamental analysis after I screen the stocks technically. If it is buyable, I will buy. Because you can read a book by Robert Vegan, Applied Portfolio Analysis and Equity Management, Portfolio Management. He writes in his book, in fundamental analysis, what is the first step? You analyze whether the business is great or not. Okay, it is great, first checklist. Second, you see if it is undervalued or not. Second checklist done. Third is that you think it is undervalued, your neighbor should also think it is undervalued, then only the price will move up, because the perception of others should change. If it is undervalued, everybody should feel that it is undervalued, then only the price will move up. So you have to, in the third step, identify the catalyst that will change the perception of the masses. He writes in his book, he's a fundamental investor. So the moment it changes the perception and they buy into, the price and volume will show me on the chart, okay, something happening in this company. So you read the book by Sir Nicholas Darvas, that will help you a lot.
Great way to. I mean, I totally agree with this. There was one question. So, simple moving averages or exponential. So, is there any segregation which you see, or we can use both?
No, sir. This question I actually miss a lot. EMA, SMA, nothing far fancy about it. Uh, Simple moving average is giving equal weightage to the past n days price, whereas in exponential you are giving more weight to the recent data. So let's say you are taking 200 days moving average, may be possible that 200 days before company uh, might be different. Now there is new management within those 200 days, so the price moved up violently. I want to give more weightage to the recent price, so exponential moving average is used for that. So when you open the any chart, just open 200 SMA, 200 EMA, you will see huge difference between both of them. That's why I use exponential moving average. And on lower period moving average like 10 SMA, 10 MA, there is hardly any difference. So I that's why by default I always use EMA, exponential moving average.
Great. Although you already discussed, but any successful or unsuccessful trades, one or two each, you would like to tell us so as to, in the form of example or case studies, maybe.
So many were like when I told you micro cap investor, I made mistakes in fundamental analysis. In technical, I was doing a lot of mistakes. Like I was averaging down Ashok Leyland when it was moving down in initial days 18, 19. I was not aware of uh, like was not having courage to book my loss. So I didn't realize that I have to keep my losses very small. I was averaging down in many stocks. So then slowly and slowly you realize, so those were those trades where I made a loss. Then I practiced enough. So now losses will not be huge. If a stock gaps down, I can do nothing. I can just sell at the next price. But usually I haven't seen that situation where the stock gap down 15, 16% in my case. Uh, but yes, the majority of the mistakes were like sometimes I sold the winner too early. So like ITC, when I bought at 270, it was a bigger position size for me. So I sold half position too early. So I should have trailed it. So from 270 to 320, 330, it went up peacefully. So mistakes were on the part of early sell, and mistakes initially were on the part of faulty buys, like the base was not good, like uh, BEL, if I remember, or maybe BDL trade, where the setup was not good. So it was not actually a buy, but I bought it. There I made mistake. So now if you ask me like about the stop loss, I would definitely take my stop loss much quickly now. Mhm.
There is one question around target, like how when you enter a trade or maybe for swing trading, so you have the exit in mind, right? So how you decide on the target?
I trail with the shorter period moving average, sir. So don't have a target. Don't just think that the stock can. It's a 50 rupee stock. It can go till 80 or 90. No, don't have a target. Just trail it with a shorter period moving average. Maybe you can book some portion and make the trade risk free. After that, you do not know how long the stock can go. So don't have any target unless stock becomes mad and moves up violently in a vertical move like GameStop or nickel future chart in February or January, February, I think, when it moved up 3x. Only in those cases you have to sell quickly, like IRCTC. But in other cases, as long as it is moving up peacefully, don't have a target. Just keep on trailing it. I don't focus more on targets. I just keep my trailing stop losses active, and I just trail them as long as it goes.
Great. So, Himanshu, we almost covered most of it. I tried my best to keep all the questions in my capacity. So, anything which we missed asking you and you want to tell our attendees for the day?
I think we pretty much covered everything, but if there will be any unanswered question, I usually always full day I'm uh, tweeting. So I will retweet, like someone was asking, I think on Varun Beverages or some individual stocks. So I will be retweeting those on my timeline. And I think Other than that, yeah, we almost covered everything: stock selection, entry point, exit point, and market direction. Mhm.
Okay, okay. So Himanshu, like you also teach people. So would appreciate if you would like to tell if somebody wants to get in touch, so that would be helpful for them. Yeah.
I just take 1 or 2 batches in a year, so as of now I'm not teaching. So if I have any plan, I will announce. But as of now, I'm not teaching anything. I'm just sharing the tweets which are like freely available on my handle. Other than that, I'm not teaching as of now. So if there will be a plan, I'll post it on Twitter. Mhm.
Great, great. So I mean, although Imanshu, like helping people over, obviously we are trying our best to helping the community, but this is a thankless job, and we often get questions around like, are you doing it for money or whatever? So for all our attendees, like be it the guest or be it me, we are doing this purely educational thing, and there is no sort of commercials involved, right? So we are doing it in good faith, and the idea is like we also learn and we also spread, or maybe we have a responsibility towards the community. So this way we are trying our little what we can do for the community. And on the top of that, less obviously we appreciate if you connect with us, so that the hard work or the experience which we are sharing can reach to more people. So with this, I would request, surely if you are liking, so you should have a, you should reciprocate, or maybe say thank by connecting with us, and surely there would be value addition, no sort of hidden agenda as of now. And if down the line there would be any such thing so as to monetize ethically, that would be announced publicly. Yeah, Imanshu, any closing remarks for the day?
So thanks for hosting me. It was a pleasure answering so many great, insightful questions, and you are doing great job. So I was checking your handle like I said before. So kindly follow his page, because you will see so many podcasts that I myself will see now, because when I see 80, 85, now he said 85, I was thinking, I was just able to scroll here. So I will request him to share his YouTube channel link, where even I can go through the podcast in sequence, or maybe many fundamental technical aspects covered there. So you will learn a lot. So thank you very much for having me. So I hope it was all equally insightful for you. So it's always, learning is always mutual. So thank you very much. Thank you very much.
Thank you so much, Himanshu, for sparing time. And before I say these words again, so Vishad is one speaker which we
Ye-
got lately. Vishad,
Yeah, yes,
quickly
sir.
unmute.
Just one question, Himanshu bhai. If
Yes.
market starts reversing and starts weakening, and if you hold some positions which are stronger, as example, I have one AC action construction equipments. So do
Hmm.
you still trail the with shorter moving averages, or you just close the position if market start weakening?
Actually, what happens, the entry and exit now, it's firstly, the intent of the trade is already decided in advance at the time of entry, if it's a positional trade or if it is a swing trade purpose. Because I have seen even in weaker markets, stocks have, you have to follow the rules, because as per your rule you are going to hold it positionally as long as the trend is intact. Then irrespective of the market condition, I have seen stronger stocks making a move of maybe 100 to 100% even in weaker market. I can share plenty of examples. Phenotex Chemical, you see the chart from 170 to 400. Mirza International, BLS International, then you have Elecon Engineering. So you never know which stock can move up 100 to 100% even in this market. So better is to just keep on riding the trend peacefully as per the rule based approach. So there is a book written by Sir Curtis M. Faith, Ways of the Turtle. It's a rule based trading process. So in even in weaker market, if my intent was to hold it positionally, I will be riding as per the set rules and principles in here. Because if my stock is strong, I will let the individual stock just run its course rather than the market, because I'm saying you like Venus Pipe, Nasdaq, they all moved up 100 200% in this week market. So Hindustan Aeronautics in this week market. So you do not know which stock are you holding that has the potential of moving up 200 300 400%. So better to have your exit criteria irrespective of the market direction. Only when your stop losses are hit in those cases, because sometimes in swing trading 6 7 stop losses are hit together, or your stock instead of hitting the stop loss will make a climax move 50 60 70% within 3 days or 4 days. That's the best time to offload your shares during late stages. Mhm.
I think that answers your question, Vishal. Okay. So Himanshu, thank you so much, bhai, for your time, and it is always pleasure listening to you. And Shubham bhai is also there since starting. So if we want to join and say hello to Himanshu and me, so the Himanshu bhai, मतलब आपकी clarity is like next level, and sincerely telling like people are really benefiting from your handle. You share your views, but I would tell each and everyone attendee in this spaces today, please take that as a starting point to study. We had n number of names during this conversation. Those were purely examples, because until unless you tell it with an example, things are quite difficult to make you understand over a what we say audio podcast, right? So please don't act on that, and take this as a learning exercise. Screen as many charts you can, so as to form a visual connect with the chart. In that manner you can surely benefit in the long term. Hi Shubham bhai.
Uh, good evening, Prince भाई. हिमांशु भाई नमस्कार. uh,
Namaskar.
So
हमेशा
Shubham
हिमांशु
bhai,
भाई को
like,
सुनने में मुझे पर्सनली काफी अच्छा लगता है. इसलिए अब वैसे ही मार्केट ऐसी चल रही है, कुछ ज्यादा स्टॉक्स है नहीं, तो भाई कम से कम सुन ही लिया जाए कुछ अच्छे लोगों को. और रिसेंटली तो मैं हिमांशु भाई से मिलकर भी आया था दिल्ली में, तो
Mhm.
इट वाज अ ग्रेट एक्सपीरियंस. और जो उनका स्टाइल है और जो बताने का तरीका है, मेन चीज क्रक्स ये है कि भाई मार्केट में सिंपल चीजें काम करती हैं. तो हिमांशु भाई का भी यही एक मोटिव रहता है कि सिंपल चीजें बताई जाएं. लोग भरोसा नहीं करते जब तक कुछ कॉम्प्लेक्स चीज ना बताई जाए. 50 60 इंडिकेटर चार्ट में लगा लेने का, जिससे कि प्राइस चार्ट दिखे ही नहीं और सिर्फ इंडिकेटर दिखे, तो लगता है कि यार कुछ अलग है. जबकि सिंपल चीजें काम करती हैं. हमारा जब पिछला स्पेस हुआ था आपके साथ, तभी मैंने यही कहा था
Mhm.
कि सिंपल चीजें करेंगे तो बिल्कुल वो काम आएंगी. तो उसी पे फोकस रखना चाहिए, नॉइज से बचना चाहिए. वही टेक अवे है मेरा. और थैंक यू वेरी मच
Mhm.
हिमांशु भाई फॉर शेयरिंग योर इनसाइट्स. और
Thank you. We'll
ऑलवेज प्लेजर टू
definitely.
लिसन टू यू.
Thank you very much. We'll definitely plan a meetup again. So we'll
next
post.
time Himanshu bhai, next time मैं भी आ रहूंगा ना.
Sure.
जरूर
Definitely.
जरूर.
Sure.
तो शुभम भाई, आई मीन शुभम भाई, जो हिमांशु भाई का ग्रेट वर्क है उसको अप्रिशिएट करने के लिए मैं अकेला कम पड़ रहा था, तो मैंने आपको बुलाया. एंड इट इज आल्सो ग्रेट टू also great to have you in the community. You are also doing a great work. So guys, काफी लोग अभी भी confused हैं recording को लेके. So let me tell you, this session is recorded and I have pinned one or two tweets over this spaces. If you check those tweet, you will get a link to YouTube channel as well as a link to this spaces. So when we close, you will obviously can listen to the spaces over that tweet. And additionally, as soon as possible, I try to place this podcast over YouTube so that you can revisit it any point in time. So keep joining and keep supporting. Your love is really market में कुछ भी please don't go for short term gratification thing. Always try to learn what works for you, and market is eternal, so spend some time. Don't be like you have to do it today only. Take your time. When you feel comfortable and confident, then only you can play big. But simply trying to copying others and losing your hard money doesn't help. And especially if you go blaming someone for that is not acceptable, because it is your mistake. You copied. That person has not asked you to do that. So with this, I thank you everyone who stayed with us for almost 2 hours, and it was great insightful session from Himanshu bhai. And as he say, technical analysis is an ocean. तो उस ocean से पानी निकालने का फिर प्रयास करेंगे sometime down the line. Again, we have a session with Himanshu bhai and Shubham bhai for sure. So thank you again, Himanshu bhai.
Thank you very much for hosting me. Thank you. Thanks a lot.
गुड नाइट गाइस. और बुक्स के नाम भी आपको मिल
Good
जाएंगे,
night.
रिकॉर्डिंग भी मिल जाएगी. यू विल गेट एवरीथिंग. जस्ट यू कैन फॉलो अस
Mm.
एंड यू विल गेट द अपडेट फॉर श्योर. थैंक यू. गुड नाइट.
Thank you. Good night.
Thank you. Good night. Good night, everyone.